The volatility continues. It's not going away. We see one day the market's up 1.5%. The next day it's down 1%. Markets have been all over the place. We've seen financial markets pop off of those lows that were put in a couple weeks ago and have marched upward. We've seen the meme stocks run, crypto run. But again, it's hard to get a lot of clarity on where we're going forward. And that's what we're talking about today. Looking at the charts, getting a technical look at the markets, and trying to make sense of all of it. I'm Andy Gersher, and this is Gains. To get some clarity, let's bring on Jim Welsh. We talk to him often, macro strategist and portfolio manager at Smart Portfolios out of San Diego. And of course, his website, as always, macrotides.com. Jim, always great to have you on the Gains podcast.
Always fun to join you, Andy.
So a lot of activity as of late. We have seen markets, financial markets come off those lows. They put in at the beginning of the month, end of February, beginning of the month. We've seen a lot of volatility. What's your read on stocks right now, Jim?
Well, the market has become modestly overbought, as one might expect after the move up we've seen over the last 3 weeks. I think the move up has been funneled in part by short covering. Because sentiment was deeply negative prior to the low, and that means people take out, establish short positions and so forth. And as they do that, and the market goes against them, they're forced to buy to cover those short positions. So that definitely contributed to part of the rally. In addition, the option expiration that occurred on March 18th also contributed, Andy, because prior to the expiration, the market had sold off. So those who were short calls, as the market then subsequently rebounded and the S&P got above 4,300, 4,350 and so forth, calls that were out of the money and virtually worthless all of a sudden are worth more and more, which then also forces the dealer community to cover positions in order to, eliminate the upside risk that they were exposed to. And then, of course, hopes that Russia will turn out okay. And to me, the oddest one, Andy, is the faith that the Federal Reserve will be able to engineer a soft landing over the next 12 months. And we can talk about that in more detail if you would like. But
yeah, I mean, in fact, just picking up on how you started the conversation, you talked about short covering. And now, and then you referred to that, was that the triple witching day on Friday? That's what you're referring to. And at some point, I want you to actually explain why triple witching days are significant. And you just mentioned also there are hopes of peace between Russia and Ukraine, or a dial back at the very least. And this is in the backdrop that you talked about the Fed. The Dow theory, which we talk about often on the Gains podcast, is negative right now. My gut is I kind of have this feeling that it's this peace news may be sell the news scenario. So I just wanted to kind of hit on a couple things here. Let's start with, do you think that this Russia, Ukraine, and a little bit of cooling off here driving this? And I think once things get resolved, there may be a bit of a sell the news scenario. So let's just start with Russia, Ukraine, and we can hit on some of these other things as well. Yeah,
again, obviously, people believe that if the war stops in Ukraine, that will bring down oil prices, which I think would very likely do that, at least modestly. The problem I have, Andy, is that, if the shooting stops, and that will be a very good thing, at the same time, there's damage that has been done to various markets, and I'm thinking of grains and foods and the food supply and the cost of fertilizer, and some of these problems predate the Russian invasion. So all the Russian invasion did is boost fertilizer prices that much more. They were already up over 100%. And what that means for a lot of farmers around the world, they can't afford to pay that much for fertilizer, so they wind up planting less, which then means the crops that are going to come to fruition 6 to 9 months from now are going to be of a smaller harvest. And there's a number of other examples I can give, but
well, and they're not even. I mean, there's probably not a ton of planning going on in war-torn Ukraine as well, which is a major producer of grain.
Yes. And so the point I would make is that, hey, on the one hand, it's a great relief to see the violence stop. The damage is going to persist far longer because they aren't going to be able to do the planting that they need to do in the next few months, or certainly at the levels that have been done in prior years. So food prices are going to continue to ramp up. The sanctions against Russia are not going to be removed anytime soon. So there's longer-term ramifications that are going to remain in place, even if they come down to some kind of a resolution to stop the actual fighting.
Well, and I think an important point to make here is, as horrible as this Russia invasion on Ukraine has been on citizens of Ukraine, I mean, there's bloodshed, I mean, horrible things that we're seeing on television. A lot of the issues for the economy, and you even mentioned that with the fertilizer, even fuel, oil, and so forth, were already in place, and then we've seen peaks, put on by the, Russia's invasion of Ukraine. But there all along was, under the surface, issues already. The Dow theory, as I mentioned, is negative. We've mismanaged our energy, in my opinion, and others. There's not going to be any kind of quick solution to the global energy issues. So there's really, and the Fed still, I mean, we've been printing money for years and years and years here for the last couple of years. The Fed's going to get a handle on that. And I think that was the other thing that you had said earlier that, and I agree with you 100%, how they think that the Fed is going to be able to orchestrate some kind of soft landing when we still have all these other things going on in the background is a head scratcher for me.
Yeah, as I'm writing the April macro tides, Andy, and if I went back to 1948 to look at all the tightening cycles, and there have been 14 tightening cycles since 1948, and the Fed has engineered a soft landing 3 times. So that means 22% of the time the Fed has been successful of tightening policy and avoiding a recession. It also means 78% of the time there was a recession following a tightening cycle. And the 3 windows, or the 3 examples that Chair Powell cited a couple of weeks ago, 1965, 84, 94, I look at the levels of GDP, the inflation rate back then, the unemployment rate, and comparing them to the challenge that we face today is significantly worse, if you will, today than any of those other instances. So not only has the batting average been really pretty low, I mean, I jokingly make a comment that if your home team had a winning percentage of 22%, no one would be bragging about how common their wins are. And that's what Powell said. It's common for us to achieve a soft landing. Well, I don't think 22% of the time is common. And the unique challenges of this situation, I think, is just going to make that just a lot more difficult because of the volatility coming from so many different sectors, not just here in the U.S., but obviously globally.
I can't speak for 1965, but 1984 and 1994, I've lived through both of them, it feels a lot different then and what was going on in the economy, in the world, and everything compared to now. Is that fair to say, without a doubt?
Well, what I go through is in 1982, the U.S. economy experienced the worst, deepest recession since the Great Depression. So it was a very deep recession. GDP growth contracted by 1.8%. So the rebound, and the reason that happened is the Federal Reserve had pushed the Fed funds rate up to 20%. Mortgage rates were extreme, like double digits, 12 to 14%. And so you had a lot of pent-up demand. So once the Fed did lower interest rates, it unleashed that pent-up demand. So the economy grew very strongly in 1983, and in 1984, I believe the growth rate was like 7.2%. So my point, and the unemployment rate was 7.3. Well, it's 3.8 now. So the labor market had a lot of slack back then, which made it possible for wage growth to kind of be pretty modest, as opposed to what we're seeing over the last 12 months. And the labor market is extraordinarily tight. So to me, again, as I went into the detail of those three examples that Powell cited, this is far more challenging than any of those three instances. So, but again, the willingness of investors to believe that, okay, we can do a soft landing. This morning, another Fed governor was on CNBC. Yeah, I'm confident we can do it. Well, no one's going to say, if you're on the Federal Reserve Board, gee, I really don't know if we can pull this off. It's a real long shot.
Right. And in fact, people are going to hurt really bad when we make further missteps, because if you go from our track record as of late, it's not too good. No, they're not going to say that. I'm joking. But again, last year they stuck with the inflation is going to be transitory for about 6 months, from like June until almost December, when it was obvious that all the things that were making inflation so bad were not improving. And so the willingness of people to just want to believe whatever the Fed tells them, to me, is kind of remarkable, as you noted, given some of the track record that they have, in their history. So, but that's where we're at mentally. And the one thing I draw a comparison, Andy, is back in 2018. The market sold off 20% into late December 2018, and then Powell indicated that they were, not raise rates in 2019, and then in January they began to expand their balance sheet again. So my point is that here we are, where we're exact opposite. This rally would make sense if the Fed had just said we're slashing interest rates and we're going to start a QE program. Instead, they're doing just the opposite, and they're going to be doing it in the face of a slowing economy. And this is the one point I would make that I think is important. I hear equity investors say, well, the market's already discounted the 7 or 8 rate increases. And, look at the 2-year Treasury yield. It already reflects all those increases. That all is true. What the market, I don't think, can fully appreciate is there's a difference between the 2-year jumping to 2.2% and the impact on the economy. And we're going to see housing slow materially. We're not going to see auto sales pick up because the computer chip problem is still with us. In fact, just to put it in perspective, I read today, the EV Hummer, super popular. If you're getting an order now, you're not even going to take delivery of that vehicle until 2024, citing the same things you just mentioned there. So we're seeing it across the board in chips, go ahead, in housing. And
so, I've noted in the last 6 months, that the consumers are sitting on a fair amount of savings. And that is acting as a cushion to this initial wave of inflation over the last 12 months. Plus the desire just to get out and, kind of return to some sense of normalcy as far as getting on a plane, going somewhere, going out to dinner, catching a movie. People have been willing to pay extra. Prices are up, but they're willing to pay it, A, because they got the money, and B, they just want that semblance of normalcy to be a bigger part of their life. I think one of the key things that's likely to happen in the next 3 to 6 months, Andy, is because prices are continuing to push higher, we're going to get slowly but surely more and more consumers starting to back away. We're already seeing it in the bottom 10 to 20% of wage earners. The increase in energy prices is hitting them really pretty hard, obviously depending on the occupation, maybe severely. But I think over the next 6 months, slowly but surely, as consumers, work off some of their additional savings that they have from all the government stimulus money that was distributed last year, slowly but surely, I think consumers are going to start to balk at higher prices. And I think this is going to be a real test for the stock market. It may be 3 months, it may be 6 months, but at some point in time, if that starts to develop, it means that profit margins are going to come under more pressure because the demand has been so strong, companies have been able to raise prices. I think that pricing power is going to gradually erode for the balance of this year, and that is going to have an impact on profit margins. It's going to take a while to develop, but I think once it becomes obvious that consumers are, in fact, starting to balk, that's another hurdle, I think, for the equity market.
Hey, real quick, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts, if that's an option for you. And as always, subscribe and turn on those notifications so you know when a new episode drops. We drop Gains episodes on Wednesday and Friday mornings. There was a slight change in our schedule, and now you can get that fresh Gains episode Wednesday and Friday mornings. Okay, we're going to be right back with Jim Welsh talking markets. We'll take a look at some key levels we're watching and all that when we get right back from the break.
If you enjoy learning about communities, culture, and history, then Shades of the City podcast is for you. We will bring you stories like the legacy of Johnson Publishing Company, most notably known for Jet and Ebony magazines.
Basically, what the world said African American people could not do, these magazines proved otherwise.
Subscribe now to Shades of the City on the Odyssey app, Apple Podcasts, or wherever you get your podcasts.
Back with Jim Welsh, macro strategist and portfolio manager at Smart Portfolios in San Diego. His website, macrotides.com. And then, hey, Jim, real quick for your plugs, go ahead and get them in here. You always have some plugs and some special things for the Gains listener.
Yeah, I'd be happy to send yesterday's weekly technical review, which I discussed some of the things that you and I have just covered in more detail, plus a real technical viewpoint on not only the S&P 500, gold, the dollar, silver, gold stocks, and, of course, Treasury bonds. So it really covers all the markets, and I think your listeners will appreciate that.
And
so all they have to do is send an email, Jim Welsh Macro, WELSH at macro@gmail.com.
And speaking of technical levels that we're watching, and the Gains listeners should probably grab a piece of paper here and a pen. What levels are you looking at here, Jim, as significant areas of both resistance and strength for the market?
Okay, first let me preface, Andy, the detail because I think this is important. Again, my take was coming into this year that we would see a 10 to 15% correction in the first quarter, which obviously unfolded. Now the question mark is that correction over? I mean, have we in fact made a bottom and we're on our way to new all-time highs? Because that was my view. We'd have this correction, and then the S&P would rally above 5,000. And at this point in time, from my perspective, the jury is still out whether or not the correction is done. So potentially, in technical terms, the initial decline that we saw that bottomed in February and March would be wave A, and that this rebound is a wave B. And typically, a B wave would be three legs: an up phase, a down phase, and an up phase. And if you look at a chart of the S&P, Andy, you can kind of see pretty clearly that so far all we have is three waves in the rally from 41.15. And we're nearing the end of what would be this third part of that rally. If the correction is completely over, we'll see a pullback in the S&P towards 4,400, and then another rally that will take the S&P up probably above 4,700, maybe even 4,750, and that will complete 5 up. And that then would be, in my opinion, a confirmation that the bottom is actually in. Now, irony is that if you get that fifth leg up on this rally, you'll then get a wave 2 pullback that could retrace 38 to 61% of the move up. So there'll be a decent-sized pullback that'll probably bring the S&P down to 4,400 to 4,500-ish, give or take. The alternative is that wave A bottomed at 41.15. This is a big three-wave rally for a B wave, and we're going to see another decline that not only tests 41.15, but actually takes it out. And
I'm in that camp, by the way. I'm in that camp.
And I'm leaning that way, too, because fundamentally, as I noted earlier, in 2018, the Fed eased policy and the market rallied like crazy. In 2020, the Fed eased policy, plus we had an enormous amount of fiscal stimulus. Now we have just the opposite. We have the Fed not only going to be raising rates, they're also going to start to trim their balance sheet. And if you look at a chart of the Fed's balance sheet in 2018, while they were also raising rates, the S&P went into a trading range for most of that year and then wound up dropping 20%. So to me, these are the headwinds that support the idea that, okay, this rally will probably be done in the next week or two, and then I think the door could be open for a decline that goes back down to 41.15. So right now it really comes down to whether or not we get this dip to 4,400 or so, 44.50, and then a rally back up above whatever high is struck here in the next few days for a complete wave 5 from the 41.15. So to me, this is probably a good place to take to lighten some exposure, because if we get the wave 5, we're going to get a pullback below where we currently are priced, and if this is a B wave, the C wave down is going to drop the S&P down below 41.15, or at least test that level. So taking some money off the table at this point in time, Andy, I think makes some sense within that framework.
Going back to the Russia-Ukraine thing, it seems like, especially this week, cooler heads are going to prevail here a bit. There may be a bit of a de-escalation there. How does this all play into the overall markets at this point?
Well, it's a factor. In my own opinion, it's an emotional short-term factor, whereas the course that the Federal Reserve is on is a much important factor going out the next 6 to 12 months. A lot of talk today about the yield curve inverting. Historically, the lead time, once the 2-year goes above the 10-year, is 19 months. So we're talking a super long lead time.
I just want to throw that in there. I did not realize that's so when that occurs, you don't even see the result of that play off for almost sort of 2 years or a year and a half.
Yeah, exactly. Now, obviously there's variability. It could be 14 months in one cycle and 23 months in another cycle, but the average was 19 going back to the 1950s. So it's a reliable indicator. It's just like way out in the future. I prefer looking at the leading economic indicators, the LEI, which is a composite of 10 different economic statistics. Historically, the lead time on that is 10 months, and that hasn't turned down yet, Andy. So personally, I'm leaning more on that, A, because of the timeliness, but also because it gets away from some of the machinations that I think are taking place in the Treasury market with everything that's going on. So, again, I'm not in the recession camp for 2022. I think any risk of a recession is sometime probably in the second half of 2023. And so to me, it's almost out of mind, at this stage.
Oh, yeah. I mean, that's just so far in advance. And what's your read on the Dow theory going bearish right now? Does that mean anything for you?
It is it's a broader approach where you need the Dow and the transports to make new highs or make new lows. And so there's a lot of wiggle room in the middle. And I have an indicator called the Major Trend Indicator going back to 1928. Does a pretty decent job of identifying bull phases, bear phases. And last Thursday, it generated a bear market rally signal. So it signaled that, okay, we got into a bear market during that decline, and now it's given a bear market rally signal. And, so that says,
but still a rally in the bear market, right?
Right.
Okay.
And in order to, if you will, confirm a new bull market, that has to continue to rise over the next few weeks and reach a certain threshold. And it very well may do that. So I'm open-minded to the idea, hey, the bottom is in, but I think that 5-wave up pattern is really important to kind of confirm it. And it isn't there yet. And once it is there, we should have a decent-sized pullback of 200 to 300 or so S&P points for wave 2 before the real fireworks to the upside would happen. So, again, I just think we're at a spot, trade location-wise, if you will, where buying here, I think, is just I don't think it's wise. We've seen a real pickup in speculation in terms of the meme stocks with GameStop, AMC, even the move up in Tesla. So the call option traders, which went nuts last year in February and June, are back in force. And what they do is buy call options that are way out of the money. Now the dealer community has to sell those options, so they're effectively then short Tesla or whatever the stock those options are on. And that's what happened with the triple witching, is that as stocks and indices started to move toward and above important strike prices, the dealer communities effectively short those stocks, and they were forced to then cover. And we're seeing that kind of action play out, I think, in the last 3-4 days as well, Andy. So that normally is a sign of speculation. So, again, a lot of people, to me, it just seems like the fear of missing out has come in back and forth. And people are oblivious to whatever happens in Ukraine, oblivious to, okay, maybe the yield curve inverts, maybe it doesn't. More importantly, the Fed is going to be hiking rates, shrinking its balance sheet as we get evidence that the economy is, in fact, slowing. And at some point in time, whether it's this upcoming quarterly calls by companies, I think they're going to be important. Do they start talking about, gee, we're going to lower our guidance for the balance of the year because our costs are going up and rates are going up, and we think the economy is going to slow. So these are all the things that I think have the potential of creating the reason for the market to have another leg down and potentially get all the way back down to 41.15. But right here, right now, Andy, I can't in good faith say, gee, I think this is a good time to buy really anything, because the downside risk here is 500-600 points potentially on the S&P, and in the very short term there may be about 100 points left on the upside until we know based on the pattern and so forth. But the signs of speculation, again suggest we're nearing some kind of a short-term high, and then we'll just see what kind of a pullback. If the S&P drops much below 4,400, 4,350, to me that will immediately kind of say, nope, we're not going to get that fifth wave. We're going down for a retest. There's just no way of knowing right here, right now.
It's interesting. Those meme stocks did have that pop off the bottom, have now stalled out in the last session or two. Another one that we see it as growth, crypto on the koi side, underneath the surface is had a nice little run, over the last couple of weeks. So is there any chance that the S&P just goes straight up and then retest those, what is that, 48?
The high?
Yeah, the highs.
48.18. Anything is possible. When you get into kind of a speculative mode, which is to me where the market has gotten, given what we're seeing with the meme stocks, the option traders and what's happening there, and just the mentality. Yeah, you can just keep going. I mean, this morning, the area around 4,600 was, in my opinion, somewhat significant resistance because there were a couple highs during the month of February just under 4,600. Well, we gapped over it this morning, and now there's a gap below the market on the S&P at about yesterday's high, which was 45.76. So, I think that gap is going to get filled, Andy. And again, the main thing I would point out, for me that is the most important, is monetary policy is going in the opposite direction than it was in December of 2018 and March of 2020. And I just think there's a lot of novice investors out there that are clueless.
Those novice investors that you speak of that are clueless, for years now, and I've talked about this several times over the last month where if you haven't been in this for a while, this game, the last couple of years, hey, buy the dip. And every time you buy the dip, that stock comes back and even gains more. I mean, these investors see, hey, you have a pullback. It's an opportunity. Pull back, you buy the dip. But you and I both know that when things start sliding, you will get crushed if you buy the dip and it falls, and you buy the dip and it keeps falling.
Going.
And we've been there.
And then you run out of money if you're playing with options.
Right, exactly. And you can run out of money fast. Yeah.
Now, the one thing I'd like to note is that as the market was declining during February, as you know, we talked. It had a low, the S&P had a low of 42.23 on January 24th. I expected a bounce, and then I said the S&P was likely to drop below 42.23. And what I told my subscribers was that, hey, if it gets below 41.75, do a little buying under 41.50, and do a little bit more under 41.25. And as good fortune would have it, the S&P gapped down on February 24th and traded under 41.20. So anyone who, my subscribers basically were given a gift in a sense that the market gapped down, triggering, if you will, all three of those incremental buying levels on the opening of the 24th of February. So sometimes it doesn't hurt to be a little lucky, too.
Gosh, I think luck doesn't hurt to be lucky a lot of times.
Yeah, we wish our sports teams could be a little more lucky than they usually are. So I think that there's a little too much enthusiasm right here short term. Yes, we can follow through, but I think the market is going to have to contend with the other shoe. Meaning, and I'm glad we're going to talk about this. Okay, when Powell gave his presentation to the National Association of Business Economics a week or so ago, he acknowledged that the Fed doesn't have any control over some of the problems, things like computer chips, the labor market. They can't address some of the dynamics that have been and will continue to put upward pressure on inflation. But the one thing we can do, he said, is to reduce demand. Now, that's a very significant statement that I think a lot of people have just ignored. It's kind of like, okay, we're going to get the soft landing, nothing else matters. But the way they're going to achieve that soft landing is by raising rates and tightening policy enough to reduce demand. And that means, again, a slowdown in the economy, an intentional slowdown at the behest of the Fed and monetary policy. And I think that's when those headlines start to show just how much things are slowing, that is likely to be a hurdle because inflation is so high, Andy. You can't say, the economy's slowing, the Fed's going to stop raising rates. Unfortunately, we're not there. Now, if the Fed, and as you know, back in January, I was talking about the Fed front-loading the rate increases. They should raise rates in March, May, and June. Now, back then we were talking 25 basis point increases because, that was like somewhat ahead of the curve. Because coming in this year, most people were talking 3 increases, and I'm like, hey, I think it's going to happen March, May, and June. So they may be more aggressive in one of those meetings or two, actually increase it by 50 basis points. But again, unless they get real evidence that the economy is slowing so much as to raise some real concerns about a recession, I don't think we're going to get the relief on the inflation side that I thought was likely to happen in the second quarter. It's not going to happen as much because gas prices have, obviously gone up even more. The food prices are going to continue to creep higher. So the headline number for the CPI, when it comes out, I think on April 12th for March, it's going to be north of 8%. And there will be some relief in the second quarter because the year-over-year calculations, we take off what happened in May of 2021, June of 2021, and there were some big numbers back then. So there will be some relief. It's just not going to be enough to, I think, get the Fed to think, we don't have to do any more. Again, when Powell said, what we do need to do is reduce demand. So that means for a while they're going to be oblivious or ignore any real slowing in the economy, because that happens to be exactly what they're trying to accomplish.
Yeah, it's and to think that you're going to have a soft landing by doing that, you want to soften demand. I mean, that's a problem, and that's going to impact earnings and other things as well.
Yeah.
And that's going to impact the market.
Yeah, I think so. I mean, again, that's the risk. So that's why I don't think we can flash an all clear until, again, there's 5 up in the S&P. Then we see a pullback, and that will be the time, I think, to add. Again, I was fortunate that the market gapped down on February 24th and triggered all that basically at the low. That ain't going to happen again, I'm sure, for a while, Andy. Again, this is just not a good time, I think, for anybody to commit money. In fact, I'd be inclined to say if some of the stuff that you've been, holding on to that got pounded really hard has rebounded, you might consider taking some chips off the table, just because I think there's another pullback coming, even though ultimately I think the S&P is going above 5,000. I think there's a new all-time high coming. It's just like, okay, how do we navigate some of the squiggles over the next 2-3 months?
What vehicles are you using right now to play the market in any way? Are you shorting? Are you using indexes? Yet. Are you just sitting tight?
Okay.
What's the play?
In terms of the S&P, I'm flat. I mean, to me, in my opinion, most of the rally's over, and it's too early yet to go short, because I want to see some more deterioration on the momentum and so forth in the S&P. A week or two ago, I recommended some EM exposure via South Korea and Malaysia.
For our Gaines listeners, okay, so when he says EEM exposure, he's talking about the iShares MCI Emerging Market ETF. That's EEM, right? You said
let me clarify it, Andy. I'm talking about like the umbrella of the emerging markets, and specifically with, in terms of getting exposure in emerging markets, specifically then drilling down into South Korea.
Okay, what vehicles do you use? Okay, go ahead.
EWY.
Okay.
Is South Korea, and Malaysia is EWM.
Now, are you still also finding EEM, the broader emerging markets, attractive here as well, or are you only comfortable with the boil down to said those EWY or EWM?
Yeah, I'm only comfortable because, again, if there's going to be another leg down to 4,100 or lower, all these sectors are going to get hit. The reason I chose the two, South Korea and Malaysia, is they've started to hold up better especially Malaysia, towards the end of the correction. Malaysia actually was creeping higher. And South Korea is way oversold in terms of relative performance to the S&P. There's an important support area around 68 or so on EWY, going back a number of years. So, I'm comfortable like holding that kind of exposure, because if we do go down and hit new lows, that stuff I think is very likely to hold up better than the actual emerging market ETF that you were referencing, EEM, in that kind of environment. So until I'm convinced that the bottom is in, and, again, my hesitation is more driven by the fundamental aspects than, the 5-wave up stuff is important for me technically. But, in terms of all the rest of the stuff, the main conviction comes from just looking at the fundamental side of the equation and where monetary policy is going, economy slowing, all that kind of stuff. To me, those pose potentially pretty big hurdles because, again, the Fed's not going to change the direction of monetary policy just because the economy slows. Now, in prior cycles, that was the case. We got like in 2018, economy started to show signs of slowing down. The Fed stopped raising rates and reversed. That's just not going to happen in the next 3 to 6 months.
Another area of the market that it's kind of been a bit disappointment considering everything that's gone on is gold really has not delivered. We've talked about gold in the past. Why, first of all, why hasn't it delivered? You would think conditions like this, anybody who's familiar with, the things that move gold, conditions like this, I think a lot of people would have thought that gold would be $2,500 an ounce.
Yeah.
We always talk about GLD as our vehicle for gold. But what's your thoughts on GLD and gold?
Well, I think as long as gold holds above 1880, and in the weekly technical review from yesterday, I said I think there's a chance that gold is going to drop below 1900. I didn't expect it today. I just said, okay, it's setting up for a drop below 1900. And as long as it holds above 1880, I think gold has a decent shot of making another run at 2070 sometime this year. So I recommended gold a few weeks ago when it traded under 1925. And in anticipation, so basically what I told people, hey, when gold spikes up, you don't want to buy it. Instead, wait for a pullback. Gold spiked up to 2067 and then pulled back to, I think, 1902 initially, then bounced again, and then came down this morning to 1890-something before strengthening again. So I just wanted to buy it on the pullback in anticipation that gold has the chance to go up and make new highs. One difference thing here, and to answer your initial point and question, Andy, is why didn't gold do better? Well, in June of last year, I was looking for the dollar index to make an important trading low just above 89. It did, and I thought it would rally to 99 to 100, and it has. And I think that was a major headwind for gold. It just didn't get traction, in part because I think people were like, oh, the Fed will change policy at some point in time. That's good for the dollar, maybe not so good. Again, also the theme last year was, don't worry about inflation. It's going to be transitory. Why do I need gold if inflation is going to be a passing fancy? I think those are and then crypto had some great moves last year. So some of the capital that may have historically gone toward gold, I think, there's a younger generation that could care less about gold, but they care a great deal about crypto.
Yeah, I agree with you there. I believe the silver / gold trade, some of those folks that are in crypto would have been in that space, say, 20, 25 years ago.
Even 10 years ago.
Yeah, even 10 years ago. Before crypto, crypto's been around maybe 10 years or a little longer. Yeah.
So I think, again, it holds 1880. I think there's a move up. What I am looking at is Treasury bonds, because I'm a contrarian. In other words, when everyone's negative or positive, I'm going to lean the opposite direction. And that's like short term. Everyone seems to be pretty optimistic about the market right here. Okay, it's time for a short-term high. On bonds, everyone hates bonds, and I get why. But Treasury yields, I think, are nearing a trading low. This is kind of like in the vein of a scalp trade, where I think TLT over the next few months has the potential to rally to 138 to 140. Today it closed just under 131. So we're not talking about a huge move, but it does, yield, I think, 2.5%. So you get a little carrying charge in your favor. But I just think that things have gotten so overdone in the bond market that we're likely to see Treasury yields come down for a period. And again, if this is a B wave in the stock market and it's ultimately going back down to retest 41.15, that would be something I think that would be supportive of the Treasury bond market. So, that's a contrarian play, but I think it's time to look at buying. As you know, months ago, I thought, okay, it's a great time to short the bonds. And bond yields have obviously risen a lot. What led me to say it's time to short the bonds was, people were really complacent last year about inflation. Oh, it's just going to be transitory. I don't think so. And now I think it's just time to switch to the other side. It's gotten overdone. I think yields have the potential of coming down. And, time will tell. But that's the one trade that I would say that I'm comfortable with. And then a longer-term trade, and you and I have talked about this, is uranium. I think slowly but surely the world is coming around to seeing that there is a place and need for nuclear power, that green energy is just not sufficient and reliable enough to replace fossil fuels completely. We've got this transition that's going to take a while, And if you want the cleanest energy out there, it's nuclear. And, I read an article not too long ago. People, the green mentality has reached, I think, absurd levels. So like in Germany, they've reduced their number of nuclear power plants from 17 in 2011 to only 3 now. And they're still planning on closing those 3, which is, to me, mind-boggling. But because they got so freaked out about Fukushima. But in the meantime, Andy, they're going to continue to get 27% of their energy from coal. Now, what kind of a green idiot could actually think that that's a good plan if you're really trying to cut emissions?
Yeah, we've seen some of these policies by cutting energy sources in favor of going to green energy sources that aren't ready yet. They've actually been dirtier because they've been forced to burn coal and dirtier crude oil. That Global X uranium ETF that you're speaking to, we've talked about it many times on the Gains episode. That ticker for the Gains listener, by the way, is URA, Global X uranium ETF. That's a great point that you've made on uranium and energy. And this thing's actually hasn't done too bad since we first started mentioning it close to the beginning of the year, so that was a nice little trade.
It's held up. I mean, I believe that it will make a move up towards 31 sometime this year. And I like the way it's been trading in the last month or so. For a while there, it would react to oil. If oil prices are going up, that's going to imply that people are going to want to move toward nuclear power and uranium, and it would rally. And then over the last week or two, and anytime oil was weak, uranium was weak.
I noticed that, by the way. I did notice that, and I saw that rally with oil, and then it now trading kind of lockstep with oil.
Yeah, and so today CNBC had a fellow on, and I can't remember his name, but he was the energy secretary under President Obama for, I think, from 2012 or 13. And then he was around for the first year of Trump's, and then I'm sure he got replaced because he wanted somebody on his team to be that. But he was on CNBC and extolling the virtues of nuclear power and how important it is that we use that as the bridge to get us to where we want to get to in terms of utilizing green energy sources, but in the meantime, creating energy that is a bridge and that can supply the cleanest energy going. I read something not long ago where if you compare a solar panel farm, for it to generate an equivalent amount of energy that a nuclear power plant would, it would take 400 times the land mass.
You could say the same thing about wind farms, too. They're just not – I mean, they take an enormous amount of space. Yeah.
It's fine. They're out in the boonies somewhere, but then there has to have transmission lines to go to bring them to where the energy is truly needed.
And they have to be maintained. There's a lot, actually. There's a lot to them. It's not just turnkey and that's it, and you forget about it, and you have unlimited energy forever.
So I'm just hoping that with everything that's going on here, Andy, there will be a reassessment of nuclear, because since Fukushima in 2011, nuclear power has just been in the doghouse, and the technology exists today. I mean, 3 Mile Island, that plant was started building, I think, in 1966.
Well, yeah, I mean, 3 Mile Island was like in the 70s. I mean, first of all,
by the time the plant was completed.
No, I mean, when they actually had the 3 Mile incident, that was 70s, I think, late 70s. If you're ever in that area, you can still visit.
Well, I remember going to the movies in China Syndrome, and 3 weeks later 3 Mile Island happened, and it was like, wow, if you wanted a promo for a movie, you couldn't have gotten a better one.
I think the point is the technology, safety technology, and everything that goes into producing nuclear power has changed significantly since then.
Yep.
I think they're more on point with a lot of the even safety concerns now versus even, say, 10, 15, 20 years ago. Hey, Jim, as we're wrapping up today's Gains podcast, your takeaway from our conversation, your thoughts on things going forward.
Well, just in summary, the Federal Reserve has basically set a course to diminish demand. That's the one variable that they think they have control over. And as they do that, that means higher rates, tighter monetary policy, and slower economic growth. And I think that, to me, is the one message from Powell that I haven't heard anybody else talk about, and it's maybe, I think, the most important part of what he said. There's a lot of things outside our control. We hope those things improve. The one thing we can do is reduce demand. So that normally is not good for equity investors. And then secondly, the idea of a soft landing in the current environment is just going to be really challenging. Now, the reality, though, is we won't know whether the Fed is going to be successful for probably 9 to 12 months from now. So, it's just like, okay, that's a back burner issue. But I think, as I said, the next few weeks are going to be important from a chart analysis on the S&P, whether or not the bottom is in fact in. And so hopefully, we can talk in a few weeks and we'll see what the S&P has done, and then we may have a whole different game plan for listeners.
All right. Well, hey, great conversation today, Jim. That's Jim Welsh, macro strategist and portfolio manager, Smart Portfolios out of San Diego, California. As always, the website, macrotides.com. Give us your final plugs, Jim.
Jim Welsh, macro at Gmail, and I'll be happy to send you this last week's weekly technical review.
All right. Sounds good. Appreciate it. We'll talk to you again soon.
You got it. Thanks, Andy.
All right. That wraps up the Gains podcast. As always, hey, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts, if that's an option for you. And as always, subscribe and turn on those notifications so you know when a new Gains episode drops. Our Gains episodes now drop on Wednesday and Friday morning. So be sure to check us out there. And I will see you on Friday morning.
A News Radio WBBM podcast powered by Odyssey.